Good afternoon, boys and girls. I'm Raymond Dahlman, and this is the Liberty Call for Wednesday, January 12th, 2022. Hope everybody's having a fantastic day out there in the interwebs. Pretty unremarkable day in the markets. It's kind of up, kind of down, but looks like all the major indexes settled in the green here in the United States. But nothing too exciting. The news on the TV seems to be centered around inflation and elections or election reform that the federal government wants to do. Personally, elections should be left up to the states. That's just my own personal opinion. But anyways, if it's your first time watching, be sure to like, share, and subscribe. And let's go ahead and dive into how the markets did today. All right. Dow Jones was up 0.11 to settle at 36,290. S&P 500 was up 0.28 to settle at 4726. NASDAQ was up 0.23, closed at 15,188. And small caps were down 0.76 to settle at 2174. The VIX was down again today, down 4.29%, down to 17.62. So that looks pretty good, considering the volatility we've been experiencing. And hold on one second. Like I said, with the volatility we've been seeing over the past few weeks, it's good to see that number going down. Across Europe, lots of green. Looks like the best performing was the S&P BMV IPC. So it looks like Spain. That's like the Spanish flag. And across Asia, lots of green. It looks like the Hang Seng came in at the highest at 2.79. So across the board from last night, overnight in through today, everything looks pretty good. All right. So got a couple articles. Inflation is the big topic right now. And this first one comes from the Wall Street Journal. Why 7% inflation today is far different than 1982. I can tell you the big difference for me from 1982. I was in the second grade. Well, I guess going into third grade. But I was not someone who was out buying and selling stuff back then. But I lived through it. And I remember my parents bitching and moaning about inflation and interest costs and things like that. But anyways, all right, let's go ahead and dive in. Let's see who wrote this. This was written by Greg Ip, and it was published today. All right. Consumer price inflation in December at 7% was last this high in summer of 1982. That's about all the two periods have in common. Today, the inflation rate is on the rise. Back then, it was falling. It had peaked at 14.8% in 1980, while Jimmy Peanuts was president and the Iranian Revolution had pushed up oil prices. Core inflation that year reached 13.6%. So whether or not our true inflation rate is that high, it's tough to tell. The way that the inflation rate has been calculated has changed a lot over the last 4 decades. You can actually go to, I think, the Bureau of Labor Statistics or one of those government websites, and you can see all of the adjustments of it that have been done for the CPI, really since the beginning. So, but I looking at the chart or the bullet points, the changes really started to heat up in the 70s and 80s. So as far as being able to compare, what our true inflation rate is, in apples to apples, it's a little tough today. All right, let's get back into this. Upon becoming Federal Reserve Chairman in 1979, Paul Volcker set out to crush inflation with tight monetary policy. In combination with credit controls, that effort pushed the U.S. into a brief recession in 1980. Then, as the federal benchmark interest rate reached 19% in 1981, a much deeper recession began. By the summer of 1982, inflation and interest rates were both falling sharply. 4 decades of generally low single-digit inflation would follow. We had a dramatic success in getting the inflation rate down on one Fed official observed that August, but Mr. Volcker had other problems to contend with. High inflation rates had pushed Mexico into default, touching off Latin American debt crisis, and unemployment would climb to a post-World War II high of 10.8% that fall. Unemployment took out that record in the early months of COVID-19 pandemic. Since then, it has been falling rapidly as the economy soars back to thanks to vaccines. It's debatable. Fewer restrictions on mobility and ample fiscal and monetary stimulus. Probably way too much stimulus, in my opinion. In December, unemployment sank to 3.9%, closing in on a 50-year low of 3.5% just before the pandemic. Monetary policy then and now couldn't be more different. Back in 1982, the Fed was still targeting the money supply, causing interest rates to fluctuate unpredictably. Today, it largely ignores the money supply, which expanded dramatically as the Fed bought bonds to hold down long-term interest rates. Its main policy target, the federal funds rate, is close to zero. Rather than 1982, two previous episodes when inflation reached 7% might hold more useful lessons for today. First was in 1946. The end of the war had just unleashed pent-up demand for consumer goods and price controls had lapsed. Inflation reached nearly 20% in 1947 before falling all the way back. Today, consumption patterns have similarly been distorted and supply chains disrupted by the pandemic. Inflation also topped 7% in 1973, although driven in part by food and energy. That fall, Arab exporters would embargo the U.S. for supporting Israel in the Yom Kippur War. This was a continuation of a rise that began in 1966. Like today, the 60s increase followed a long period of low, stable inflation and low unemployment. Excuse me. Like President Biden today, President Lyndon Johnson initially blamed inflation on industry-specific microeconomic factors. Then Fed Chairman William McChesney Martin, in part due to pressure from Johnson, was late to recognize that demand was too strong and that the public's expectation for inflation were coming unanchored. I doubt President Johnson knew a damn thing about what caused inflation. A key challenge facing current Fed Chairman Jerome Powell is deciding whether today's inflation has more in common with 46 or 1966. For now, he sees a bit of both. On Tuesday, he blamed inflation on strong demand and supply constraints and emphasized the risk of expectations coming unanchored. The Fed could start raising rates in March. Mr. Powell also has things his predecessors lacked, namely the knowledge of their experience and a free hand from the president who just nominated him for a second term. So, what we've been hearing about a lot lately is that interest rates are going to climb up to maybe the 2% range. I mean, just in this article, it mentioned that interest rates went up to 19% to, quell the inflation that we were seeing. So, I don't know. It's like taking a bucket of water and trying to put out a forest fire when what you really need are like those tankers that fly around and dump the water on top of the fire. So, it's kind of like pissing on a campfire. You're not really going to accomplish a whole bunch. All right. Next article is U.S. mortgage interest rates surged by most in 2 years. The interest rate on the most popular type of U.S. home loan surged last week to the most in 2 years and climbed back roughly where it was before the coronavirus pandemic struck. After signals that the Federal Reserve would be raising rates sooner and faster than previously expected, the Mortgage Bankers Association on Wednesday said its weekly measure of the average contract rate on a 30-year fixed mortgage jumped to 3.52% in the week ending January 7th from 3.33 a week earlier. So that's 19 basis points that it went up. That was the largest weekly increase since March of 2020 and pushed the prevailing rate to around where it was just before the pandemic triggered a recession and drove borrowing costs to historic lows when the Fed cut its benchmark rate to near zero. That era appears to have passed. However, mortgage rates have been edging higher for the past several months. But before the large jump in rates last week followed the release of the minutes of the Fed's December meeting, the readout showed policymakers were preparing to combat surging inflation with higher interest rates and likely a reduction in Fed holdings of more than $8 trillion of treasuries and mortgage-backed securities. So just to put that $8 trillion number in perspective, that's 2 years worth of tax revenue from the public. So, as far as, securities that the Fed has purchased off the open market, I mean, I think they were sitting around 3 to 4 trillion when this all started. So, within 2 years, they bought up, well, they did most of that within a year. They bought up, a year's worth of tax revenue, just scooping these up off the open market. So so to put that in perspective, I mean, that's a lot of money. And, Anyways, that's that is crimping mortgage application volumes, especially for loan refinancings with rates now around half a percentage point higher than where they were 3 months ago. Rates at these levels are quickly closing the door on refinance opportunities for many borrowers. Although refinance activity changed little over the week, applications remained at their lowest level in over a month, and conventional refinance applications were at their lowest level since January of 2020. So I guess if you're going to go out and refinance your house, probably now is the time to do it. I know that's something that we had looked at a couple of years ago with our lender when rates went down, and it just didn't make sense for us. We already had a really low interest rate as it was, and then the additional borrowing costs to refinance the loan, it just didn't make sense. I mean, we would have pushed up our mortgage balance, like I think by about $12,000 to do that, and it's like, why? It would take years to recoup that difference, and didn't make the lender real happy, but oh well. So, all right, let's see what we got next. The third article I have here: why you may need to save twice as much as why you need to save twice as much for retirement as your parents. Well, probably because the cost of living has doubled. But let's see what this person has to say. This was written by Patrick Villanueva. All right. How much will you need to save before you can retire? It's a simple question at the root of most people's plans for their golden years. Answering it, however, can be far more complicated. Using research that re-examined the viability of the popular retirement planning strategy known as the 4% rule, a Morningstar portfolio strategist found that current savers may need to stash away twice as much money each year compared to the past savings rate of people who are already retired. For decades, the 4% rule has been a pillar of retirement planning. This basic rule of thumb, developed by financial planner William Bingen in 1994, dictates that retirees can stretch their savings over 30 years by withdrawing 4% of their nest egg in the first year of retirement and adjusting subsequent withdrawals for inflation each year. The simple strategy aims to provide a steady and reliable income for retirees with balanced portfolios of 50% stocks and bonds. The classic example is often used to illustrate the 4% rule. A retiree with $1 million in retirement savings using the rule, this hypothetical retiree would withdraw $40,000 in the first year of retirement and then increase subsequent withdrawals by the rate of inflation. Doing so will all but ensure they won't run out of money for at least 30 years. But Morningstar researchers say low bond yields and an overvalued equity market are the primary reasons for a 4% withdrawal rate may no longer be feasible. Instead, they found that a 3.3% is a more appropriate initial withdrawal rate for retirees with a balanced portfolio who are seeking fixed annual retirement income. So personally, I've always used a 3% number. I try to err on the side of caution. And, for me, that has, when I'm just kind of doing ballpark numbers, to me, that's always been easier. So if you have $1 million saved, what's 10% of that? 10,000 multiplied times 3. So you could reasonably take out $30,000 a year, and then inching that up with inflation over time. But the 4% rule, sometimes you could use just a 5% number if you're just trying to do a quick ballpark number. So if someone says, I want to live on, $50,000, you divide it by 5%, and then that will give you what the gross balance would need to be. So in that case, $50,000 at 5%, 20th, so it'd be about $2 million is what you would need to have saved. Or I'm sorry, I can't do math in my head anymore. So $50,000 divided by 0.5, or dollars divided by 0.05. So yeah, you need $1 million to produce 50 grand. So, all right. What else here? Amy C. Arnett, a chartered financial analyst and portfolio strategist at Morningstar, explored two possible implications of the new 3.3 withdrawal rate in her recent piece. What lower withdrawal rates mean for retirement savings. First, a retiree needs to generate $40,000 in income, will need to have more saved by the time they begin withdrawing their money. If their initial withdrawal rate is 3.3%, while a person following the 4% rule could withdraw $40,000 during their first year of retirement, are not calculated that someone adhering to the 3.3% withdrawal rate would need $1.21 million in savings, or 21% more than the person following the 4% rule. So That is true. I mean, it's again, I would err on the side of caution. Run this through multiple retirement planning calculators just to see does it make sense or not. Also, why you need to save more? Simply because life has gotten more expensive. So, all righty, and then I got one more article here. Let's see, 4 reasons why stocks are poised to outperform. Four reasons why value stocks are poised to outperform growth in 2022, and 14 stocks to consider. So let's see what they have to say here. This was written by Michael Brush. All right, investing is all about being in tune with the trends. Here's one to be aware of for 2022. Value stocks will most likely beat their growth counterparts. The trend is already underway. Consider the Vanguard S&P 500 Growth Index exchange traded fund, which is VOOG, is down 5.6 year to date, while the Vanguard S&P Value Index Fund, VOOV, is flat at 0.08 in the positive. Value groups include banks and energy stocks, are crushing growth stocks like ARK Invest's favorite names. The KW Bank Index and the Energy Select Sector ETF are up 6%. In contrast, the ARK Innovation ETF has slid 13%. That ETF is filled with growth darlings like Tesla, Coinbase, Teladoc, and Zoom. Here's a look at 4 forces favoring value over growth, followed by 14 stocks to consider. So, number 1, rising interest rates favor value stocks. A lot of investors value stocks using the net present value model, especially high growth stocks that have expected earnings in the distant future. This means they've discounted projected earnings back to the present day or to the present using a discount rate. Typically, the yield on the 10-year treasuries, which is 1.737 at this time, when the discount rate goes up, the NPV goes down. So naturally, when the 10-year yield rises, as they are now, expensive stocks in areas like tech underperform the cheapest stocks in areas like cyclicals, financials, and energy, point RBC Capital market strategist Lori Calvasini. Likewise, price to earnings multiples are the most expensive stocks become inversely correlated with the 10-year yield during Federal Reserve hiking cycles. She points out the reverse is true for value stocks. The least expensive stocks have historically outperformed the most expensive stocks when the 10-year yield is rising, she says. Ed Yardeni of Yardeni Research, very good company, projects a 10-year yield could rise to 2.5% by year end from around 1.79% right now. If he is right, that suggests value outperformance will continue, though there will be counter rallies in growth and tech along the way. Here's a chart of RBC Capital Markets showing that his value historically outperforms as yield rise. The blue line represents bond yields, and the dark blue line represents cheap stock performance relative to expensive stocks. So, all right, number 2, higher inflation is positive for value strategies. This historically has been the case, points out John Buckingham, a value manager at Kovitz Investment Group, who pins the Prudent Speculator stock letter. He expects a repeat now. Part of the reason is that inflation fears drive up the yield on 10-year bonds, creating a detrimental NPV effect for growth names described above. Inflation accelerated at the fastest pace in December since 1982. The government reported Wednesday that it was the third straight month in which inflation measured annually exceeded 6%. But another factor at work during inflationary times, companies with actual earnings can boost profit margins by raising prices. As a group, value companies tend to be more mature, which means they have earnings and margins to improve. Investors notice this, so they're attracted to those companies. In contrast, growth names are characterized by expected earnings, so they benefit less from price hikes. Growth companies do not make money, so they can improve margins, says Buckingham. They are paying employees more, but they are not making more money. Here's a chart. I'll skip that. Value stocks do well after recessions. Historically, this has been the case, and as you can see in the chart below from Bank of America, this is most likely because inflation and interest rates tend to rise during economic rebounds. Both trends are negative for growth stocks relative to value for those reasons outlined. And last, value stocks do better when COVID cases decline. This has been the case throughout the pandemic, and as you can see in the graph below, from Bank of America. This is probably because when COVID cases decline, the prospects for the economy to improve, which suggests inflation and interest rates will rise, both of which make growth lag value historically. Omicron is spreading fast. Spreading so fast, the case count is likely to peak at the end of January, so this effect may kick in soon. In the chart below, the light blue line is the COVID case count. The dark blue line is the relative outperformance of growth to value. When the dark blue line declines, it means value stocks are doing better than growth stocks. So you can see, okay, interesting. All right, and I'm not going to go into all the. I'll list off a couple of the names that they listed here of examples. So their examples are Citigroup, CVS, General Motors, Kroger. Kroger's in here in the Denver area. Kroger's in hot water with the strike that's gotten started with their labor. MetLife, Omnicom Group, Pinnacle West Foods, Verizon. So it's mostly like they said earlier, it's your more stable companies that are, they've been around for a long time. They usually produce dividends. So those are typically your value companies, and they typically do better in uncertain times, or in recessionary type situations, as opposed to growth, where your growth stocks are typically going to do very well in I don't want to say overheated markets, but markets that are strong and usually on a strong uptrend. All right, well, that's everything that I had for today. If anyone needs anything from me, or you have a question or a concern, or you want to get started on some financial planning, be sure to reach out. There's my email address right there on the screen, and I'll be back tomorrow with the Liberty Call for Thursday. And everyone, have a wonderful evening. Bye bye.